Good morning, everyone. Welcome to Windsor Brokers live daily market outlook for Tuesday, 27th of November 2012. As widely expected and finally announced, Eurozone and IMF secured the deal on cutting long-term Greek debt. This was the final meeting yesterday as finance ministers and IMF clinched agreement in reducing Greece's debt in a breakthrough to release urgently needed loans to keep the near-term bankrupt economy of Greece afloat. After a long time, approximately 12 hours of talks at their third meeting in as many weeks, Greece's international lenders has finally agreed on a package of measures to reduce Greek debt by 40 million euros, cutting it to 124% of GDP by 2020. This is what we were talking about yesterday. And in a significant new pledge, ministers committed to taking further steps to lower Greece's debt to significantly below 110% in the 2022. The most explicit recognition so far that some write-off of loans might be necessary from 2016, the point when Greece is forecast to reach primary budget surplus. To reduce the debt pile, they agreed to cut the interest rate on official loans, extend their maturity by 15 years to 30 years, and grant Athens a 10-year interest repayment deferral. The Eurogroup chairman Jean-Claude Juncker said the ministers would formally approve the release of a major aid installment needed to recapitalize Greece's teetering banks and enable the government to pay wages, pensions, and suppliers on December 13th. Some positive tone finally came in the market, although the moves were not reaction basically on the release was not that strong as initial optimism that was persisting during the past week. I think it has already been priced in the current rally, and the brief reaction, especially of single currency, that briefly broke above psychological 130 support, and the beginning of European session now reversing lower on the corrective action has seen that the investors have already been aware and priced in of the decision, and priced into their euro longs. Most likely corrective action is now going to be the next step, but overall tone for the single currency remains positive. More risky situation seen on the sterling, which approached and hit basically yesterday's high end at 160.50, but so far fails to break it higher, and the increased risk is seen of formation of double top in case of further extension lower and break below significant 160 support. Dollar yen remains in the corrective mode, although some bulls have been regained on the bounce following yesterday's brief break below 82 support. Still we are short of 82.45 zone Fibonacci resistance and the trend line resistance, and basically failure to regain this level is again increasing risk of the further downside extension, as overall bears are still in play. Dollar Swiss is in the brief corrective action, but tone is skewed towards the downside, and our initial target at 92.13 with some corrective action signaled by technicals on the 4-hour chart. Of course, more detailed outlook we're going to have in our technical part, seeing a corrective action preceding a fresh weakness. Commodities, crude oil remains stable, holding around 88, while the gold is also stable, but in sideways narrow range mode. I think we mentioned yesterday in our technical outlook for commodities that the gold is expected to move somewhere between 1740 and 1755 levels. That exactly happens. 1745 on the downside and the 1752 on the upside are the limits. Quite a narrow range, stabilizing the recent last Friday's strong rally that peaked at 1752, and after clearance of a very important barriers at 7 and our targets at 1738, 1746, 48. More prospect is seen towards the upside, and most likely the current movements are seen as consolidation before a fresh push higher, where we have targets up at 1760 and 1771. From today's calendar, we're going to take a brief look. Important is the UK's GDP, where we have it. GDP for the third quarter. I do apologize. There is again some mix-up in our calendar, that things that are already released came at the bottom. Anyway, the GDP is due at 9:30 GMT. It's expected to show no change, 1% growth in the third quarter, and this is actually going to be quite interesting. I think ahead of U.S. data, durable goods orders due at 13:30 for October. Quite a significant descent in the forecast is seen as minus 0.6% is the forecast for a month of November on the monthly basis, compared to 9.8% in the month of September. Also the core ones for October, pardon, I do apologize, this is for October, not for November. The core ones also are forecasted at minus 0.6 compared to 2% in the month of September. Quite a significant drop, at least according to the forecast for U.S. durable goods and orders. So we have also the Fed Chairman Ben Bernanke having speech at the same time at 13:30 GMT, and then we have at 1400 the S&P Case-Shiller Composite 20 metro area home price index for September. 2.9 is forecast for today, in September, compared to 2% in the month of August. And the U.S. consumer confidence is due at 1500 GMT for November. It's forecasted to tick higher, 73.1. Today's forecast compared to 72, November's forecast compared to 72.2 in the month of October. And finally, U.S. home price index monthly release for November due at 1500 GMT. 0.4% is the forecast compared to 0.7% in the month of October. And that's all from the calendar. That is a bit better, more rich than yesterday's one as the week is progressing. And we're going to take a look now at the major currencies and commodities to see what are the expectations and the forecasts for today for euro and the other major currencies, as well as crude oil and gold. As from the commodities, single currency has cracked psychological 130 barrier on yesterday's brief break to 130. Overnight's brief break to 130.07 as a part of the broader recovery from 126.60. This is the low of 13th of November, with positive sentiment, overall positive sentiment still seeing keeping the upside favored and probably to drive the pair higher. However, a regain of 130.20. This is the double top of 25th and 31st of October 2012. It's shown here, as well as 76.4% retracement of 131.38 to 126.60. At 130.25. Break of these levels is required basically to confirm the positive, bullish stance and confirm break above 130.00. Of course, with today's close above this level, to give additional confirmation and give more validity to the current move. From the other side, extended conditions on the 4-hour chart has shown that RSI is already emerging out of the overbought territory, and the MACD is quite extended, along with momentum that started to point lower, and the stochastic is well below their limit line, signaling some possible corrective action. Also, the possibility of stall is quite high at this point, as 130 acts as a quite strong support, and basically the break below yesterday's low at 129.42 could be a signal of some stronger corrective action of the, if we take the Fibonacci levels of the latest uplift from 127.35, 21st of November low to 130.07 today's high, we can see that this is approximately 23.6% retracement and reinforced by 55 days exponential moving average, and basically break of this level is to signal stronger recovery. Signals of reversal are also seen on the hourly MACD and the RSI bearish divergence as shown on the hourly chart. That could be signals for some stronger corrective action preceding, of course, the stronger fresh rally. 129.42 is seen as the next is initial support, strong support ahead of 129.00. That marks 38.2% Fibonacci retracement of the uplift from 127.35 to 130.07, and also it's around figure support. Basically, ideally, any reversal should find a good support at or above 129 in order to keep immediate bullish tone in play for possible fresh extension higher. As break above 130.00 and 130.20 as our initial barrier faces 130.70, which is the high of 5th of October 2012, and then we have a tentative bear trend line at 130.95 along with the 131.00 as round figure and psychological resistance, break of which, regain of which basically to reintroduce previous tops at 131.38 and 131.70. Yes, that positive sentiment still sees the upside favored, though the no clear break is still seen on the above daily Ichimoku cloud. The top as Ichimoku studies are still need further extension higher to confirm the bullish stance, as the Tenkan Sen line is still below the Kijun Sen 1, and the break above 130.20 as I said earlier is required to confirm the bullish stance and the open way towards 130.70 and 131.00. As said, on the downside, the loss of 129 could be a signal of stronger reversal and corrective action down towards important 128.40 previous highs and 61.8% retracement, loss of which to revive bulls and keep the upside targets at 130.00 on hold. The British pound seems to be losing traction at 160.50. This is yesterday's high, ticked this morning after a brief corrective action, found support at 159.95, approximately 160.00 psychological support. We mentioned yesterday that this is acting as good support, and any break below would delay immediate bulls. Now the situation is as follows. Appearance of doji candle yesterday now signals a possible hesitation and exhaustion of the price at this point. Still bulls remain in play, but corrective action is stronger corrective action now looms above the pair, especially in case of a loss of 160, 159.95. This is reinforced by ascending 20 days exponential moving average, and close to it is at 159.85 broken main bear trend line of 163.08, loss of which could risk double top formation and the open way for a stronger retracement of the strong rally of last Friday from approximately 159.30 that peaked at 160.49. A failure to clear 160.50, again I say, it's seen as increased risk of double top and deeper reversal in case of course, confirmation required on the initial signal required on the loss of 160, 159.90. Conversely, lift above 160.50 as well as previous to open way towards 161 zone. Before this we have at 160.92, 76.4% retracement of 161.74 down to 158.26, a break of which again to reintroduce upper barrier set 161.74 and 161.74.78. This is the double top of 17th of October and the 1st of November 2012. As said, immediate risk seen on the failure at 160.50 and break below 160.00. That would delay immediate bulls and signal some stronger recovery, as 4-hour indicators are now emerging out of overbought territory. That is initial signal for some stronger corrective action. We have to watch the 160.00 is as our initial target. Close to it is approximately 38.2% retracement, and below 50% at 159.88, close to previous high at 159.77. Could be quite risky, as this loss of these levels would revive bears and put near-term bulls on hold in favor of deeper corrective action. Dollar yen's near-term price action, as shown on the hourly chart. ADX shows bulls back in play following a dip to 81.84, where the temporary support was found. Basically, the pair briefly broke below 82.05 previous, 81.91 previous low, and 82.05 and 81.91. Series of lower tops are lower bottoms are still seeing a downside more favored, but a regain of some strength and the momentum at this point on extension to 82.31 keeps hopes of possible further extension higher, as 10 days exponential moving average already broke above 20 days one, with further confirmation required on a break above 55 days one, currently at 82.17. That will be equivalent to stretch up to 82.45, whereas the tentative bear trend line of 82.83 through 82.61 to confirm temporary bottom at 81.84 and open way towards another important barrier, which is 82.61, lower top of 26th of November, regain of which to confirm to avert immediate downside risk. The 82.45 trend line resistance is reinforced by a 61.8% retracement of the down leg from 82.83 to 81.84, while the next one, 82.61 is marking 76.4% Fibonacci retracement. Break above this level to refocus upside the barrier at 82.83. Any failure below 82.45, as the pair now currently remains congested in the past couple of hours between 82.15 and 82.30, would see increased risk of further lower top and a further extension lower, as initial momentum gain on the hourly chart seems to be fading now, as also the MACD is still holding below its midline, and the hourly RSI is now starting to point lower. Basically, failure to regain 82.45 sees risk of lower top and the extension of the larger down move from 82.83, 22nd of November peak. That my focus again, 82.00 and 81.84, loss of which to open way for a deeper reversal. Then we have 81 dynamic support at 81.63, equivalent 55 days exponential moving average, equivalent to the previous high at of 19th of November at 81.58, and then 81.00 as psychological support, also close to 50%. Break below 81 basically is to sideline the near-term bears and the open way for a stronger correction of 79.06 to 82.83. Conversely, regain of 82.61 and the more important 82.83 is to open way for a fresh resumption of the broader uptrend from 77.12 mid-September low, and open 83.00 as our next upside target and psychological barrier. And dollar Swiss remains in the steady downtrend as a series of fresh lows, with the latest one posted this morning at 92.53. Keep the immediate focus at our main support and the key support of the near term at 92.13, the low of 17th of October 2012. Regain extension to this level and break below is required to confirm the bearish structure of 99.70 and basically to signal the end of consolidative phase from mid-September. That was limited on the downside by 92.13, on the upside by 95.11, and open fresh phase lower that might be targeting downside levels at 90.41, 90.00, and more significant 89.29. This is seen on break below 92.13 and 92.00. Bearish tone dominates on the daily chart with the fresh bearish momentum building up. Needed to get confirmation on the break below 92.13 and 92.00 is around the figure support. On the upside, the immediate barrier realized at 93.00. This is yesterday's high, previous strong support and round figure barrier that capped yesterday's corrective action of previous low at 92.63. This is also 55 days exponential moving average, and basically is expected to limit immediate bounce higher. A break above 93.00 is to allow some stronger recovery in phase next, quite a strong barrier at approximately 93.30 zone, where we have 38.2% retracement of the down leg from 94.56 to 92.53, today's fresh low, and we have lows of 23rd of November at 93.30 and 22nd of November at 93.35. This is seen next on a possible break above 93. So far, the overall bearish tone sees more focus towards the downside, and unless we regain minimum 94.00, where it's also 200 days moving average, more pressure is seen towards the downside in the near term for dollar Swiss. And a little change seen on the crude oil's price action since from yesterday, as the pair peaked last Friday at 88.50 and the subsequent easing dipped down to 87.26. Basically, the it stays within the previously established range, but still the overall tone is still slightly skewed towards the upside, as long as I would say trendline support at 86.31. This is also close to the previous lows at 86.36 and 86.16 stays intact. Still a break above 88.50 last Friday's peak, and more significant 89.20 and 89.77 is required to that also mark the recent range tops, is required to confirm the recovery of 84.05 base, and the open way towards 90.00 is psychological barrier, and 38.2% at 90.42. Basically break above range. That was already signaled. The major reversal has already been signaled by breaking above diamond bottom pattern, but failure to regain some important levels such as 90.00 on latest failure seen on 19th of November at 89.77 still sees the downside vulnerable, and in case of repeated failure, further sideways movements, I would say at this point could be seen, with the important support at 86 zone, loss of which is set to reintroduce downside supports at and base at 84.00 as a part of the larger down move from 100.72 peak of 14th of September 2012. Political situation still unrest in Syria, seen in Egypt, seen yesterday, remains supportive, as well as a deal with Greece that improves the overall outlook for the Eurozone economies, but still quite strong signals of crisis worldwide, at least in the biggest world economies that are the biggest consumers of energy, still keep the oil price under strong pressure. And finally, gold, as we said, it's still within the consolidative range, narrow consolidative range, 1745 on the upside and 1752 on the downside, and 1752 on the upside. Sideways movements seen on the hourly chart, as well as 4-hour indicators that are emerging out of the overbought territory. Some corrective action is not ruled out below 1745, with 1738 seen as our reference and good support, and it should not be exceeded in a case of any deeper reversal, in order to keep the immediate bullish structure in play for a test of our upside targets that are 1756, as we said yesterday, Fibonacci expansion of the latest rally from 1705 at 1756, and the 100% Fibonacci expansion at 1771. Any break below 1738 and 1735 would delay immediate bulls, and would be a signal of some more significant corrective action. Approximately 1733 is the initial Fibonacci support, is 23.6, so it's well below our initial supports, as well as trendline support somewhere at around 1730, a break of which, of course, to delay immediate bulls. Otherwise, likely scenario, as said, will be stretched towards 1756 and the 1771 our upside targets. Overall picture on for gold remains quite positive, as daily indicators emerged above their midlines. This keeps upside in focus on the near-term recovery from 1672 low of 5th of November 2012. That was all from me for today. Please, your questions to be submitted now.